In 1995, the world witnessed the shocking collapse of Barings Bank, one of Britain's oldest and most respected financial institutions. Founded in 1762, it had survived wars and empires, yet a single rogue trader in Singapore brought it to its knees. This is the story of how unchecked ambition, flawed oversight, and a series of catastrophic bets led to a loss of $1.3 billion and the end of a 233-year legacy. Barings Bank was founded in 1762 by Francis Baring, quickly becoming a powerhouse in international finance. It financed the British war effort against Napoleon and facilitated the Louisiana Purchase in 1803, cementing its reputation as the Queen's Bank. For over 2 centuries, Barings was synonymous with stability and discretion, serving royalty and governments. Its name alone was a guarantee of security, making it. On February 23, 1995, Leeson realized his losses had reached $1.3 billion, more than the entire capital of Barings Bank. He left a note saying "I'm sorry" and fled Singapore with his wife. The next day, Barings executives discovered the full extent of the disaster. The bank was insolvent. Despite frantic efforts to find a buyer or bailout, no one was willing to assume the liabilities. Nick Leeson's story is also a psychological cautionary tale. He started with small losses but couldn't admit failure, falling into the trap of loss aversion and overconfidence. As the hole grew, he took ever bigger risks, a classic case of gambler's fallacy. His fear of losing his status and livelihood drove him to fraud. This human element reminds us that even the best systems can be undermined by individual behavior, making Imagine a bank that financed the Napoleonic Wars and helped the United States purchase Louisiana, only to be destroyed by a 28-year-old trader working in a small office halfway across the world. How did Nick Leeson, once a rising star, manage to hide massive losses and single-handedly bankrupt Barings? The answer reveals timeless lessons about risk, hubris, and the fragility of trust. Nicholas Leeson joined Barings in 1989 as a clerk, but his ambition and talent for trading quickly propelled him upward. By 1992, he was sent to Singapore to manage the back office and later became the head of derivatives trading on the CIMEX exchange. Leeson was seen as a golden boy, generating huge profits through arbitrage. However, behind the facade, he was secretly taking enormous risks, using a hidden error account number. In 1992, a junior trader made a mistake that cost Barings £20,000. Leeson hid this loss in a dormant error account, 88888, to protect his reputation. As losses grew, he doubled down, using the account to hide failed trades and unauthorized speculative positions. By the end of 1994, the account held losses of over $200 million. Leeson's dual role as head of trading and on January 17, 1995, the Great Hanshin earthquake devastated Kobe, Japan, sending the Nikkei 225 index plunging. Leeson had bet heavily that the Japanese market would remain stable, selling massive numbers of options and accumulating long futures positions. As the market fell, his losses spiraled. Instead of cutting his positions, he increased his bets, buying more futures in a desperate attempt to prop up the market. By February 1995, Leeson's positions were so large that they represented a significant portion of the entire Nikkei futures market. He needed vast amounts of cash to meet margin calls, and Barings London continued to send funds, believing his requests were for client trades. In reality, Leeson was using the money to cover his mounting losses. The lack of segregation between trading and settlement functions allowed him to fabricate records. Nick Leeson was arrested in Germany and extradited to Singapore, where he was sentenced to 6.5 years in prison for fraud and forgery. He served 4 years before being released early due to colon cancer. The collapse of Barings led to intense scrutiny of financial regulation and risk management. The Dutch bank ING purchased Barings for a nominal £1, assuming some of its liabilities, but the name and legacy were forever tarnished. The fall of Barings was not just the act of one rogue trader, it was a systemic failure. Leeson's dual role eliminated checks and balances. Senior management in London ignored warning signs, including repeated requests for large sums of money and discrepancies in accounts. The bank's culture rewarded risk-taking without adequate oversight. Auditors and regulators failed to detect the fraud. In essence, the Barings collapse underscored the critical importance of separating trading and settlement functions. No single individual should have unchecked control over both. Modern risk management emphasizes independent oversight, regular audits, and strict limits on exposure. The lesson is clear: even the most profitable traders must be monitored, and systems must be in place to catch irregularities early. Trust is not a control mechanism. Barings' culture of deference to profitable traders created an environment where Leeson could operate without question. The bank's leadership failed to understand the complex derivatives he traded. This highlights the need for senior management to possess sufficient knowledge of their firm's activities and to foster a culture where red flags are escalated, not ignored. A healthy risk culture encourages transparency and challenges assumptions, rather than rewarding blind profit-seeking. The failure of regulators to spot the massive positions Leeson held on the CIMEX and Osaka exchanges revealed gaps in international coordination. Today, regulators require greater transparency and stress testing. The incident spurred reforms in how banks report off-balance sheet items and manage counterparty risk. It also demonstrated that in a globalized financial system, the failure of one institution can have ripple effects, necessitating The Barings collapse sent shockwaves through the banking industry, leading to a re-evaluation of internal controls worldwide. It became a textbook case for risk management courses and spurred the development of enterprise risk frameworks. The incident also accelerated the consolidation of the banking sector, as smaller institutions were seen as vulnerable. For the public, it shattered the myth of infallible banks, reinforcing the need for transparency and accountability. The fall of Barings Bank is more than a historical footnote, it is a stark reminder of the perils of unchecked ambition and inadequate oversight. In just a few weeks, a 233-year-old institution was wiped out by one man's hidden trades. The lessons of Barings' segregation of duties, robust risk management, and a culture of accountability remain as relevant as ever. In today's fast-paced financial world, where algorithms and high-frequency